trading right around the $3.16 mark with a blistering intraday velocity that keeps short-term breakout traders glued to level 2 quotes. Keel Infrastructure Corp., NASDAQ KEAL, represents one of the most misunderstood asset transitions in the modern digital infrastructure landscape. If you scroll through financial Twitter, Reddit's Wall Street Bets, or mainstream financial television, the conventional narrative lazily frames Keel through the rearview mirror as a legacy crypto-adjacent player trying to catch the artificial intelligence wave. That surface-level retail consensus completely misses the structural reality of what has actually been engineered beneath the surface. While everyday retail participants obsess over daily market sentiment, meme stock chatter, and short-term volatility metrics that regularly push implied volatility north of 140%, institutional heavyweights are quietly pricing in a massive physical bottleneck: the absolute scarcity of energized, grid-interconnected land in Tier 1 power markets. The market is currently suffering from a severe cognitive bias. Standard financial media looks at legacy balance sheets, backward-looking earnings per share figures, and historical association labels, completely failing to price the value of raw, megawatt-heavy electrical real estate. We're living through an era where the primary bottleneck for artificial intelligence and high-performance computing, HPC, is no longer just silicon wafer allocation or advanced packaging. It is the brutal physics of power generation, substation availability, and grid interconnect queues that span half a decade. While hyperscalers like Microsoft, Amazon, and Google scramble for predictable gigawatt-scale capacity to feed clusters of next-generation accelerators, companies sitting on operational power assets with pre-existing substation tie-ins hold all the cards. Keel controls a massive development pipeline totaling roughly 2.2 gigawatts, anchored by strategic assets across high-demand power nodes in Pennsylvania, Washington, and Quebec, including data campuses like Panther Creek, Sharon, Moses Lake, Sherbrooke, and Scrubgrass. Yet the broader market continues to treat the stock like a speculative small-cap lottery ticket, completely blind to the hard asset value floor beneath it. Market dynamics and institutional positioning. The daily trading pattern of Keel reveals a classic tug-of-war between impatient retail capital and strategic institutional accumulation. With a high beta hovering near 3.74 and heavy representation across small-cap benchmarks and specialized indexes like the Russell 2000, the stock experiences sharp, gut-wrenching intraday swings that routinely shake out weak hands. When macro jitters hit the broader market or short-term sector rotations cause sudden pullbacks, algorithmic trading desks and retail panic selling create localized liquidity vacuums. This is precisely where institutional capital steps in. Behind the choppy tape, sophisticated market participants are methodically building positions, recognizing that a company controlling hundreds of megawatts of energized HPC earmarked capacity backed by robust liquidity, such as over $800 million in total financial headroom, cannot be judged by standard software-as-a-service valuation metrics. They're pricing the enterprise value on a per-megawatt basis, looking past quarterly net losses that are typical of heavy capital expenditure infrastructure build-outs. This creates a fascinating psychological dynamic on trading terminals worldwide. Are you currently holding a position in infrastructure plays like Keel through these choppy consolidation phases, or are you sitting on the sidelines waiting for a confirmed trendline breakout before committing capital? Drop your thoughts or your average entry price in the comments, because understanding whether retail is capitulating or accumulating right here is half the battle when dealing with high-beta institutional favorites. Here's the business model and historical context. To truly grasp where Keel Infrastructure is heading, we have to dismantle its historical framing. The company's roots trace back to the high-volatility world of digital asset mining, an era defined by aggressive capital expenditures on specialized application-specific integrated circuits, volatile token rewards, and immense power consumption.
For years, Wall Street categorized these operators as cyclical proxies for digital currency prices, subject to brutal boom and bust cycles that destroyed long-term shareholder value. But that outdated operational model has been systematically dismantled and rebuilt. Today, Keel operates as a pure-play digital and energy infrastructure landlord, pivoting its massive power footprints away from speculative coin minting and directly toward the insatiable high-margin demands of enterprise artificial intelligence and high-performance computing workloads. By controlling the underlying physical assets, ranging from coal to clean transitioned power sites in Pennsylvania to robust hydroelectric-fed infrastructure in Quebec, the company bypasses the multi-year bureaucratic nightmare of securing new grid interconnections. While a brand new data center build from scratch can take 5 to 7 years merely to clear regional transmission organization queues, Keel's existing portfolio features energized sites ready for rapid deployment. This fundamental shift turns what was once viewed as a high-risk operational liability into an elite, scarce resource defensive moat. Here's the future outlook, catalysts, and risks. Looking out over the next 3 to 5 years, the growth catalysts for Keel Infrastructure are inextricably linked to the structural expansion of global artificial intelligence infrastructure spending. As mega-cap tech giants pour hundreds of billions of dollars in capital expenditures for data center expansion, the hunt for localized, reliable, and scalable power is reaching a fever pitch. Keel's expansive 2.2 gigawatt pipeline represents a massive reservoir of untapped revenue potential. As commercial negotiations advance across its core priority sites and management converts raw megawatt capacity into energized revenue-generating enterprise contracts, shifting focus from speculative potential to concrete operational metrics, the valuation disconnect between its current market capitalization and its replacement cost asset value is bound to narrow. Yet prudent investors must weigh these monumental catalysts against very real structural risks. Infrastructure transformation requires immense capital, and while liquidity positions remain strong, the risk of equity dilution or high-cost debt financing remains a constant variable in a fluctuating interest rate environment. Furthermore, execution risk is non-trivial. Retrofitting heavy industrial power sites into high-density liquid-cooled computing environments demands flawless engineering execution, reliable supply chains for transformers and switchgear, and tight regulatory alignment with local utility commissions. Macroeconomic headwinds, shifts in federal energy policies, and the sheer pace of technological evolution in AI cooling standards can also introduce unexpected friction. Yet for the long-term investor who looks past the daily price noise and focuses on the hard, unyielding physical reality of the global power bottleneck, Keel stands as a fascinating proxy for the physical foundation upon which the digital future is being built. Disclaimer: this video is made only for educational and informational purposes. I am not a financial advisor. Any stock, crypto, or investment discussed here is not financial advice. Please do your own research or consult a qualified financial advisor before making any investment decisions. Invest responsibly. Thumbs up. Don't forget to like, comment, and share this video to support the channel.